29.99% APR, interest charged month after month. But what if Congress capped credit card interest at just 10%? Sounds amazing, right? Here's what nobody's telling you. Approvals change first. What we're covering. Before that 10% cap ever helps you, 4 dominoes fall. Approvals, rewards, fees, loopholes. Stick around because I'm giving you a 5-point watch list at the end so you know exactly what's coming. What the cap means. The talk about a 10% interest rate cap is real. It's being discussed in Washington right now, and credit card rates are already at historic highs. The average APR across all cards is hovering around 19.6%. For new cardholders, we're seeing rates between 23 and 24%. Some cards are pushing 30% or higher. A 10% cap would be a hard ceiling. No exceptions, no fine print, 10% maximum. That's a massive cut, and it sounds like a win for consumers, but here's the reality. Banks don't just absorb that loss. Approvals tighten. The first domino falls before the cap even takes effect. Banks get pickier, much pickier. Think about it. If a bank can't charge 25% interest to offset risk, they stop taking risks altogether. Risk gets screened out at the application stage. That means more denials, a lot more. If your credit score is anywhere below 700, your approval odds drop significantly. Even people with decent credit might find themselves denied for cards they would have easily qualified for before. But it doesn't stop at new applicants. Existing cardholders aren't safe either. Banks will review current accounts and start issuing lower credit limits. That $15,000 limit you've had for years, it might get slashed to $5,000. No warning, just a letter in the mail saying your limit's been cut. And when your limit drops but your balance stays the same, your credit utilization ratio spikes. That hurts your credit score. Rewards shrink. Next up, your rewards disappear. Here's the thing people forget. Those cash back bonuses, travel points, sign-up offers, they're funded by interest revenue. When interest income gets capped, the money for perks dries up. That 5% cash back on groceries, it drops to 2%, maybe 1%. Premium travel cards offering $500 sign-up bonuses, those bonuses shrink to $200 or vanish completely. Airline miles, hotel points, purchase protection, extended warranties, all of that costs the bank money. When they can't make it back on interest, they cut the benefits. The most generous cards will either scale back dramatically or just disappear from the market entirely. Fees show up. Once rewards are gutted, banks pivot to fees because they need to make money somewhere. Annual fees come back with a vengeance. Monthly maintenance fees show up. Balance transfer fees increase. Cash advance fees go up. Penalty fees for late payments get harsher. But it goes deeper than that. Foreign transaction fees that were waived on premium cards, they're back. Paper statement fees become standard. Even calling customer service might come with a charge. Every interaction, every transaction, every service that used to be included becomes a potential revenue stream. Remember all those no annual fee cards everyone loved? Those start changing. The fine print gets rewritten. Suddenly, there's a $25 annual fee, then $50, then $99, and that's just the baseline. Want to transfer a balance? That used to be 3%. Now it's 5% with a minimum fee of $10. Need a replacement card expedited? That'll be $35. Forgot to set up autopay and missed a payment by 1 day? The late fee jumps from $25 to $40. Cards that were legitimately free become fee-laden products, and you'll need to watch the fine print closely because these changes won't be advertised. They'll be buried in terms and conditions updates that most people never read. You'll only notice when you see a mysterious charge on your statement and have to dig through pages of legal language to figure out what happened. The irony? You might end up paying more in fees than you ever saved on interest.
But here's where it gets even more interesting. Credit itself starts to change shape. Banks will move away from traditional revolving credit and push installment plans instead. Buy now, pay later becomes the dominant model. You'll see more personal loans, more point-of-sale financing, more structured payment plans. Why? Because installment loans are regulated differently. They have defined terms, fixed payments, and different interest rate rules. So while revolving credit gets capped at 10%, installment products might not fall under the same restrictions. Banks will shift their business models to whatever products let them maintain profitability. The result? Less access to traditional credit cards, more structured debt products that look and feel completely different. Winners versus losers. So who actually wins and who loses under a 10% cap? Winners, people carrying high balances who pay interest every month. If you're someone with $10,000 in credit card debt at 24% interest, a drop to 10% saves you real money. That's the group this policy is designed to help. Losers, people with borderline credit trying to build their score. Anyone with a thin credit file or a score in the 600s will find it much harder to get approved for anything. The gate closes before they even get a chance. Small business owners also get hit hard. Many small businesses rely on business credit cards with higher limits. When banks tighten approvals and slash limits, these businesses lose critical access to working capital. Real-world clue. Want proof this is how it plays out? Look at states that already have interest rate caps. Credit unions in many states operate under 18% caps, and guess what? They still manage risk. They still lend money, but they're far more selective about who gets approved. Promotional caps already exist too. You've seen those offers, 0% APR for 12 months. That's a temporary cap, and it works because the bank knows they'll make money elsewhere, either from fees or from the interest they charge after the promo period ends. But a promotional cap is not a permanent cap. When the cap becomes permanent, the entire business model has to change, and that's when approvals, rewards, and fees all shift. 5 early signals to watch for if this cap moves forward. Number 1, more denials. Applications that used to get approved start getting rejected. Approval rates drop across the board. Number 2, promotional deals change. Those 0% balance transfer offers either disappear or come with much higher fees attached. Number 3, rewards get cut. Cashback percentages shrink, sign-up bonuses drop, premium perks vanish. Number 4, fees rise. Annual fees appear on formerly free cards. Monthly fees, transaction fees, penalty fees, all of them increase. Number 5, more installment products. Banks start pushing buy now, pay later plans and personal loans instead of traditional credit cards. If you start seeing these 5 signals, you'll know the shift is happening. A 10% interest rate cap sounds great on paper, and for people drowning in high-interest debt, it could provide real relief. But the gate changes first. Banks don't wait for the policy to pass. They adjust their risk models, tighten approvals, slash limits, and cut rewards the moment they see the cap coming. So yes, you might get a lower APR, but will you still have access to credit in the first place? That's the question nobody's answering. What happens if your credit card account gets closed without warning? Your credit score can drop fast, and most people have no idea why it happens or how to protect themselves. I'm covering that next, so make sure you're subscribed.